There are a ton of fixed income assets and other types of credit assets that appear to not be doing so well. But now that we have higher levels of inflation over 5% CPI, many of those assets are actually producing very low returns or even negative yielding on a real return basis. How big is this problem when we think of the credit markets?
First of all, total global credit is $400 trillion. Okay, that dwarfs the equity market, which is approximately 100 trillion US dollars. So you can see why you need to understand what's happening in the dog, because it's just a much bigger market. It's traded by very sophisticated institutions. But within that market, we have government debt, we have municipalities, states, we have corporations, we have junk bonds, we have structured product. It's a big animal. And in various parts of that animal, there's some weird things happening. So let's start with one of the most weird things. There is over $15 trillion of negative yielding bonds in the world. Now, they're mostly sovereign bonds, but there are a few corporate bonds in Europe that have negative yield, which means the buyer of that bond is actually going to lose money by investing in that bond if they hold that bond to maturity. A lot of them will say, well, I'm smarter than the market and I'm going to buy it now in anticipation of yields going even more negative, and therefore there's a price gain in those bonds. But that's like picking up nickels in front of a steamroller, right? It's a dumb investment policy. But many of these investment mandates have to own bonds. So you mentioned the 60-40 traditional 60% equities, 40% bonds. Those mandates were written, Pomp, when interest rates were at levels that you could make a decent return. So when I started trading bonds in the 1990s, well, late 80s actually, US Treasury 10-year was double digits. Now it's 1.6 something percent. I mean, you got to understand that that's been a 40-year bull market in bonds, and that is done because it's only mathematics. You can't make excess returns over the contractual returns that are in bonds. So first of all, you have these negative yielding bonds, which are not assets anymore. They're actually liabilities. So congratulations, you're investing in an asset that's actually going to cost you money. Contractually, it will cost you money. Well, that's 15 trillion of loser money right there. Then you look at some of the bigger things that are going on. So my expertise was formulated in the high yield bond market. High yield bonds right now yield around 4%. That's the Merrill Lynch high yield index, yields 4%. And I need to point this out. That 4% is before expected and unexpected default losses. So you'll say, Foss, what are you talking about? I'll say very simply, look, high yield bonds have an expected component of default because over time, high yield bonds do default, not the whole industry, but a portion of it. So there's an expected loss in that 4%. And then there's also what I call unexpected losses. When you hit a recession, when you hit some sort of contagion, when there's a systemic risk to the market, you get unexpected losses. So it could be idiosyncratic. I'm throwing out a lot of these technical jargon. At the end of the day, you are earning 4% before losses. So let's calculate some expected and unexpected losses in there, and then account for inflation, which you correctly pointed out. If you believe the CPI is accurate, you're earning negative real returns after inflation and piddly nominal returns before expected and unexpected default losses. I've never seen a worse risk return potential for fixed income in my 32 years. And I'm going to add one thing, and this is the kicker. If CPI was actually measured the same way as the original formula in 1980, CPI would be 14%, not 5%. Wow. 14%, Pomp.